you want to get active and you want to start a business, or you're already in business, then I recommend you create a corporation. Now this corporation, it could be an LLC taxed as a corp, or it can be a traditional corporation. And people often ask, well, why would I choose one versus the other? Well, it really comes down to your business structure. Number one, do you have partners? If you have partners in your business, then I would go with an LLC. And I mean, not your spouse, okay, your kids. I'm talking about a third party that you're not related to. Then I would go with an LLC, because an LLC, you have more flexibility in drafting out who controls what, who gets in trouble if they don't do something. Whereas in a traditional corp, you don't have that. Think of an LLC like a contract, right? When you're putting together a contract, you tell someone, here are my expectations. You have to do X, Y, and Z, and I have to do A, B, and C. And if not, then you're in breach of that agreement, and there are penalties that go along with that. Liquidated damages, rescission, things, you know what I'm talking about if you've ever entered into an agreement before. But with a corporation, traditional corp, that's not the way the game's played in that guy. So in that one, it's completely different. You don't have that granular ability to hold someone accountable for their inaction. And typically that's what happens in a joint venture. So that's how I distinguish between the two. Number one, when I want to come to set up one of these entities. The second thing you should look at in either going with a traditional corp or an LLC taxed as a corporation has to do with startup expenses. If you're going to start up a new business and you're going to make a major capital investment into it of $50,000, $60,000, $100,000, then you're going to want to go with a traditional corporation, not an LLC tax as a corp. And this is where so many practitioners steer people down the wrong path, and they don't find out about it until later on when they're shutting their business down, and their CPA tells them, yeah, you put in $70,000 and you never made that back with this new business startup. So you get to write off $3,000 a year. And you're sitting there, you're doing the math yourself, taking your pulse, doing the math. You're like, hell, I'm going to be dead before I write all that off. Okay, $3,000 a year. Well, if you set up a corporation, a traditional corporation, you can get yourself $50,000 in year one that you shut that business down. And that has to do with what we call 1244 stock loss. That only applies to C corporations. So if you're trying to figure out which entity to set up, it depends on a number of things. Do you have partners? If the answer to that is yes, go LLC tax as a corp. If you're going to have huge startup expenses, well, maybe they'll then go with the traditional corporation so you preserve the 1244 stock loss treatment.